Hello and welcome to another acysecurities tutorial. My name is Alistair Schultz and I'll be your host through today's trading journey. Now before we get started, we do have a risk disclosure statement that you need to be able to go through. It'll again come up towards the end of these videos, but in either case, be aware of what your trading is about and of course, consider your investments before you take the plunge on them. Now, what are we actually covering today? I have in mind to cover an overview of the financial markets and how the auction process actually works. The next step is I'm going to go through the idea of a double top and a double bottom pattern. And we're going to then move into moving average crossover techniques and a trading strategy revolving around them. And of course, some fundamental analysis and how central banks influence price. So to get started with what we're moving on to today, we're going to just jump straight into it and I'm going to talk about the auction. Now, at the end of the day, when you're actually placing trades, what you're really seeing is an auction. You've probably been to one before. Very much like a real estate service that turns up, you end up with the same thing. Now, back before the idea of electronic trading had come out, we saw people standing on the trading floor pit, waving tickets in the air and calling out their prices and trying to bid or get the best price that they can. Now, the first place to actually move to electronic trading was the London Stock Exchange in 1986. And between 1986 and 2007, we saw this transition all the way through where people were moving towards electronic trading. Now, today, you don't know what's going on next to you, let alone what's happening in the room or across the other side of it. You don't hear the auction process occurring. What you do find, though, is that you have traders still participating in exactly the same way. The idea behind the charts is that it is still the same process. It's just that computers and technology have enabled us to move beyond that. So, if there are more buyers than sellers, demand will be higher than supply and price will rise, and vice versa. If there are more sellers than buyers, then supply rises against demand and you will see that price will fall. This is the standard principles that come to an auction. Now, what are we as traders really seeing? Now, a lot of the time we will look at the chart and some people will think that it's fear and greed or it's the optimism behind it. But the reality of it is we're actually seeing the change in price that is occurring because of changes in supply and demand. Now, those very much auction principles have not changed in any way, shape or form. It still applies today. So when you look at your chart, bear in mind this. So now that you've got a bit of an understanding about the auction process, we're going to move into having a look at some trading patterns that you can actually use today. Now, some of these include double tops and double bottoms. Now, the reason I'm going to go through them is that they are commonly described, they're easy to observe, they're reliable, and you can consider them a reversal signal because that's in fact what they are. But in addition to that, sometimes they will form into a different type of pattern, being a triple top or a triple bottom. And they do resemble an M or a W. Now, if you actually look at this one, the double top looks like an M. If you look at the bottom, the double bottom looks like a W. And that's what we try and look for in price. Now, how do we do that? We are looking for these patterns in places near resistance, or in the double top case, we're looking for them near resistance. Short positions are applied to this sort of a pattern. They provide a reasonable entry, and if you've already been in long, they offer a good exit point. Now, obviously, we've already said that they look like an M. And just to put that into place a little bit for you, I mean, the shape is never static, so it's never a perfect M, but you can see the shape that's coming up here. Now, they can be seen in any time frame. It's not dependent, it doesn't matter. You can see them on a dollar-yen chart on a monthly basis, looking over the past of data entirely from like 1990. But you can then also go down to a 1 minute chart and see them on a much smaller scale. The only difference about where you see them is how far they tend to move. Now, if you see one that has about 20 pip in it, then you're likely going to see a 20 pip run out of it. And that's how we tend to look at them. It's all about the probability of a correct result. So it can be inverted, and when it is inverted, we call it a double bottom. You get the opportunity to look for a long entry when it is inverted. And of course, an exit from a short position. So it looks like the W, just like the other one looks like the M. Be wary of it, you can find them, and they're quite handy to find in price if you do. Now, continuations can occur in trends. And when I say that, I mean as in this chart here that I've got, if you look at the circle I've got labeled number 1, you can see that we've had an upgoing trend. Then it's had a little period of consolidation, and then we've seen our pattern occur. Now, in this instance, it's indicated that the trend is continuing on its path up. It hasn't signaled to us that it's the end of the trend, and if you had have been in earlier on in the phase, then you would have seen that and been going, I'm going to move my stop losses or trail a position up behind it so that I can take the next trade. Now, you can see them as a reversal at the beginning of a trend. So in this instance here at point 2, price has come down, we see our pattern, and then price is taken off. So it has signified the end of this short-lived downtrend that has occurred. Now it can also then be used for an exit and an entry. So if you were here and you saw this point here after taking the point 2 position at 3A, you would consider exiting your position because you've just had a reversal pattern showing the opposite direction. And again, at the beginning of a new trade or a new trend, you'd be able to place one at point B and let it ride the rest of the way, making it quite lucrative if you apply your money management skills correctly. Now, how do we define the pattern? It's really quite simple. I mean, obviously you've got that understanding of it looking like an M or a W, but in this instance, it's really about resistance and support levels. So at point 1, you don't have any idea that it's going to be a pattern. You can't start looking and thinking about defining the pattern until you're really at point 4. But what happens is you get point 1 move to point 2 move to point 3, and you get a bounce off the support line. Then what we're looking for is at point 4, a test of our original swing high. Now at point 4, it's rather important on how high this peak actually moves. So ideally you want it to be as either equal to or below point 2. Now once we get to point 5 and we've seen a break of our support line, that's where we're looking for our entry. And ideally that's what you want to do. You want to have your entry point somewhere around here, allowing you to put a stop loss behind your resistance line. Now, a couple of different ways to control price. Now, the first and the most easy way to do this is to run it with a fixed take profit. You run off, you find at point 5, you've defined your pattern, and you would set a stop loss behind point 4 and 2. You'd be aiming to have it behind that resistance line, just like I said before. Now, when it comes to picking where your take profit goes is where it changes. I would expect that any time, whatever you measure the distance from your entry or your neckline, as you want to call it, to your resistance line. And at this point, you measure the distance. So in this instance, I've labeled it as 10 pip. And then you want to double that distance down. So you go from the entry and come down this way now and make it 100% of the 10 pip. So if that's the case, then this distance from here to our take profit is also 10 pip. It's a 1-to-1 ratio that we're looking at using in this instance with a fixed take profit. And it allows you to sort of have a gauge of where you can expect things to go. Now, quite often, if you see it on the opposite side of a trend, then chances are I wouldn't be betting anything beyond having a fixed take profit. However, in this instance here, we don't want to be restricting what our take profit level could actually be. And if we were on the right side of a trend, whether it be at the very beginning of a trend or we saw a continuation pattern occurring in price, then we would consider using this method. Instead of running a fixed take profit at all, we run it as a trailing stop. So no take profits, and you instead use the exact same setup you did before. You start off with a 10 pip stop loss to see what's going on. You give it a little bit of breathing room just in case, and as price moves down, you trail your original stop down. So in this instance, we move it down, we get a rebound in price, and we trail our stop down to the next new lower swing low that we get, and then keep rolling it down. The next way to do it is a little bit more complicated, but it kind of combines elements of the previous two. In this mode, we call it sort of half in and half out. You run it just like a trailed stop, but you set a limit order to take out half your position, where you would ideally run a take profit from the onset. So if you placed a 1-lot trade at your entry point at your neckline here, had your stop at 10 pip behind, and then ran with a 10 pip take profit distance to here, instead of the take profit, you would run a limit order or a pending order to close off 0.5 lots of your position. From that point on, you allow your position to continue trading. So the 0.5 that you have remaining, you allow price to come back up to our lower swing high and let price roll down. And once you get to this point, you trail your stop down with it. Now this method is quite effective because it allows you to trail the stop, but also lock in some profit at the start.